This is what an ounce of gold actually looks like before anyone touches it. A thin yellow seam in gray rock, the kind of thing you could walk past in a creek bed and never see. Now guess how much rock had to die to get it out? Not a shovel, not a few tons, a small mountain for 1 ounce. Gold doesn't come in nuggets anymore. The good deposits, the ones a single person could dig out with a pickaxe, were stripped clean a century ago. Everything left is hiding inside gray, unremarkable rock at concentrations of 1 to 3 grams per ton. 3 grams, the weight of a penny, scattered through 1,000 kilos of stone. So this is what extraction actually looks like in 2026. Open pit mines the size of small cities. Haul trucks the height of 3-story buildings, hauling 400 tons of rock at a time. To pull 1 ounce out of the ground, the industry now has to move about 4¼ tons of waste rock for every ton of ore, and they grind it all to powder. Then comes the chemistry. The crushed rock gets piled into massive heaps and sprayed with a weak cyanide solution that dissolves the gold out of the stone. The liquid trickles through, gets collected at the bottom, processed, and refined. The whole operation runs for years. The gold you'd actually hold at the end, less than 0.001% of what came out of the ground. Everything else is waste, and it's not cheap. The industry's average all-in sustaining cost to produce a single ounce of gold sits between $1,200 and $1,400. That includes labor, fuel, chemicals, equipment, environmental compliance, and the cost of finding the next deposit before this one runs out. Which they will. Every mine has a death date. Here's the part that should sound insane. The companies funding these operations don't build their models around today's gold price. They forecast years out and lock in billion-dollar machines against a planning price of around $1,700 an ounce. Major producers like Eldorado Gold and SSR Mining use that exact figure in their public reserve filings. $1,700, less than half of where gold has actually traded. In January of this year, gold spiked to $5,500 an ounce. Today, it's near $4,000. But these companies plan as if it's 17. That's not pessimism. That's how you stay alive when the market swings. And it swings constantly. Plan low, survive the crash, print money when the price runs. That gold, coaxed out of rock at brutal cost, modeled against a number nobody really believes, doesn't stay in the ground economy for long. The bar leaves the smelter and walks directly into the modern world. Most people think gold ends up in jewelry or a vault, and most of it does. But there's a quieter buyer driving demand right now, and it isn't a goldsmith or a central bank. It's the device in your pocket, and the data centers training every AI model on Earth. The reason is physics. Gold doesn't corrode, doesn't tarnish. It conducts electricity almost perfectly, stays stable at high heat, and stretches into wires thinner than a human hair without breaking. Inside every CPU, every GPU, every chip running an AI model, there are gold bonding wires, gold plating on the connectors, gold contact pads. Not because it's expensive, because nothing else works as reliably for decades under thermal stress. The smartphone in your pocket contains roughly 7 to 34 milligrams of gold. Tiny. But there are over 1.4 billion phones produced every year. Multiply that out, and phones alone consume between 10 and 48 tons of gold every year, before you count laptops, servers, networking gear, or anything industrial. Now the AI boom is supercharging it. Every new data center going up to train the next model is dense with gold-plated connectors and gold bonding wire inside its processors. Goldman Sachs estimates power demand from data centers will rise about 165% by 2030, and every one of those servers needs the same metal you saw pulled out of gray rock in Act 1. But here's the twist nobody tells you. The richest gold deposit on Earth isn't in the ground anymore. It's in old electronics. 1 metric ton of printed circuit boards contains roughly 90 grams of gold. Compare that to a working mine pulling out 1 to 3 grams per ton of ore. And the discarded laptops in your closet are 30 to 90 times richer than any deposit a mining company is currently digging. Most of it gets thrown away. Globally, less than a quarter of e-waste is properly recycled. The rest sits in landfills, a higher concentration of gold than the mines pouring billions of dollars to chase. Which means the industry built to extract gold from rock is being quietly outmined by anyone willing to recover it from the trash. Once the gold is refined, whether it came from a Nevada open pit or a stack of old phones, most of it ends up the same way. Cast into bars, stamped, weighed, certified, loaded into armored trucks, driven to a vault. The London bullion market alone moves nearly $400 billion of gold per day in trading, more daily liquidity than most sovereign bond markets. The physical bars sit in professionally managed insured vaults under the streets of London, New York, Zurich, and Shanghai. They don't move much. They just sit there. That's the part most people understand about gold. But here's the criticism gold has always faced. It doesn't pay interest. A government bond pays you a coupon. A stock pays a dividend. Even cash in a savings account earns something. Gold just sits in the dark. For most of human history, the price of owning gold was the yield you gave up by not owning anything else. That changed quietly, and most people still don't know it happened. The gold sitting in those vaults, that useless metal, is now an actively yielding financial instrument. Central banks lend their gold to bullion banks. The bullion banks lend it to mining companies, jewelers, refiners. Everyone in the chain pays interest, called the gold lease rate. For decades, the rates were tiny, sometimes a fraction of a percent. But in 2025, as gold demand surged and supply tightened, lease rates spiked. Wealthy investors with private holdings started renting their bars into the lending market for yields between 2 and 5% annually, paid in additional ounces of gold. The metal isn't just stored anymore, it's compounding. But that yield isn't free money, and not all of these deals are built the same. In the banking chain, lending your gold means handing over the bar itself. You hold a promise, not metal. If the borrower fails, you're a creditor standing in line. It happened in 1990 when a major gold borrower collapsed and central banks took real losses on their loans. Newer retail programs work differently. The title stays in your name, and the metal is leased as physical inventory to jewelers and refiners. Same yield, very different risk. The interest was never free. It's the price of the contract. Think about what that actually means. Gold spent 5,000 years as the asset that doesn't earn anything, the thing you held instead of yield. And now the same bar of metal sitting in a vault is generating its own interest. The oldest store of value on Earth quietly turned into a yielding instrument, and almost nobody noticed. The rock you saw at the start, the yellow streak in gray stone, moved through brutal industrial machinery, through chips and servers, into a vault, and out the other side as a financial instrument that pays you in itself. Money in the wild.